Hey, before we get into the main part of this video, I just want to start by saying I wouldn't be paying more than maybe 3.5 times earnings for most businesses that are going to be financed through the SBA that are smaller than that, about $5 million in value range. Okay, I wouldn't be paying more than 3 times earnings. Maybe 3.5 if it's a deal that's doing close to $1 million to the bottom line. Okay, but with the interest rates being higher now, as we're talking about this topic in Q4 of 2022, I just wouldn't be paying 4 to 5 plus times earnings for most businesses. There's exceptions to every rule, but I have to speak in generalities here unless I'm working with you as a consulting client. But ultimately, I just wouldn't be paying more than about 3 times earnings for businesses. I wanted to start that conversation and anchor the conversation with this point here. Look, yes, in the following video that you're going to see, we talk about examples where you may be willing to pay a little bit more because the business has all these great intrinsic traits to it, okay? But then there's also going to be examples where I would be paying 2 times earnings. I mean, there's some deals I wouldn't do for free, by the way, okay? There are some you would have to pay me a lot of money to inherit. It's your job to understand what the true value of the business will be for you, not based on what the seller wants, but based on what's good for you. That's going to be a principal, core, foundational point of this entire video that we're going to be discussing. And it's really just paramount for you that you analyze a business based on what it will do for you, not what it will do for the seller. The seller's not going to worry about you, okay? The seller's going to worry about himself or herself. The only one that's going to watch out for you is you. Huge point, can't be underestimated. Don't trust brokers, don't trust sellers, don't even trust bankers. Everyone in doing deals other than you has their best interest at heart by definition. Just trying to be honest with you. No one's watching out for your interest like you are, okay? Now, with that said, we go pretty darn deep in this one. I mean, this is one of those where you get the notebook out and we really go into it. I'm talking to you like you're a high-end consulting client of mine. I'm talking to you like this is just the real McCoy, because it is the real McCoy, and I go deep. So get your notes out, let's dive in, let's have some fun. Hey, it's Jason here, and in this one I want to talk to you about actually calculating the right value for a business target when you're thinking about buying a business. Specifically speaking about a small to mid-sized business, we're not talking about $300 million transactions. I don't have personal experience making transactions of that size. What I'm talking about really is more of that $1 million to upwards of maybe $5 or $10 million acquisition, okay? And I want to dive into the real nitty-gritty aspects of this, because you hear a lot of phrases thrown around. You hear net income, you hear EBITDA, you hear cash flow, you'll hear seller's discretionary earnings, you'll hear owner's benefit. There's all these different phrases that brokers and listing agents come up with. In my opinion, candidly, it's in large part because if it's a little bit confusing and murky, then it's a little easier, I think, for the sell side to impose their belief of value onto you, the buy side. And so I want to educate you on the buy side. I am shamelessly a buy side guy. I am acquiring assets, so that's where I have experience playing on the buy side. And as a buy side player, I want to talk to you about how to really calculate value in a way that's going to help you be successful post-close. Because at the end of the day, however much you pay is what you get to deal with now as the buyer and as the newfound owner. And so I want you to be aware of what you're getting yourself into before the ink dries and the deal consummates. Okay, so first thing I want to talk about is finding your own way to calculate bottom line. Okay, all of those aforementioned phrases are basically different ways of calculating the bottom line for the business. And as opposed to using their metrics, any of the aforementioned metrics, what I would recommend instead is you come up with a way that you calculate how much income you expect to take as the owner, as the buyer. Okay, so you have to think about this. This is where you really have to put on your thinking cap and ask yourself questions like, how am I going to be paying for the business? Am I debt financing the business? Am I going to be bringing on excess working capital that's also going to be debt financed? Am I injecting my own capital into the deal? Am I using other people's money for both the debt and the equity? Am I bringing my own equity but then borrowing debt to bring the balance in full to purchase the business? How am I financing? How am I paying for the business? Okay, depending on, and then also, how am I financing the business as far as what debt instrument? Is it commercial debt? Is it SBA finance? Is it seller finance? Do I have a very poor credit score and I have no business experience really, so I'm having to pay an exorbitant interest rate because I'm going to more of like the private lender, hard money loan end of the continuum? right? These are questions you have to ask yourself, because understanding what your debt costs are allow you to play a little bit with how much you're willing to pay. If you're getting really great, and by great I mean cheap debt, a lot of cheap debt, low interest rate debt, then maybe you say, hey, do you know what? If it's close and you're in a negotiation with the seller, I'll give them a little more because I know I'm going to finance this in a way that's really advantageous for me, the buyer. So that's one thing. You have to really build into your deal calculator, and I have an example of a deal calculator that you can use to analyze deals at jasonpaulrogers.com. Go there, enter your email, you'll get it instantly, okay? But in your debt calculator, in your deal calculator more specifically, input the debt that is a realistic assumption of how much you're going to be paying to acquire the business. And then equally, if you have equity constraints, then you need to put those in as well. And you need to know basically how much total debt there will be. You know, you have to have those inputs understood and then inject it into your model to get a better sense. That's number one. But that's just the beginning, because when you work through that calculator that I have on my website, and again, shameless plug for the website and for my calculator, because it helps you analyze deals. Everyone watching this should be going to the website and downloading that. But as you work down the model, you then ultimately get to the point where you have to really make an assumption about how much income will the business really produce. And this is the whole topic of the video, right? So let's get into it more deeply now. And first thing I want you to ask yourself is, who's going to run the business? Are you personally? Are you going to hire a management team like what I've done with my transactions? What are you going to do? And then next question is, how much will the management team cost? Honestly, including benefits, the full package if you're going to bring on a management team. You know, their vacation pay, their health insurance, their other benefits, whatever little carrots that you're putting in there to make the management team decide to work with you in your world. How are you going to incentivize them? How much is that going to cost? Right? And what you really have to analyze, this is the key, is what is that management team's cost in comparison to the sell side management's team, which often for a smaller transaction comprises of the seller, maybe his wife. You see that situation play out a lot. Maybe a few family members. How many individuals on the sell side will be no longer working in the business as you calculate long-term what the business is going to run like? Okay, so what was that management team that was there? What were they doing? How much were they costing? And will they be stepping down? And then on your side, how much will your management team cost in total? And will they be able to fulfill all of the obligations that the existing management team was performing? That's really a huge part of this, because this is where, when you go back to those phrases we brought up earlier, seller's discretionary earnings, owner's benefit, net income, EBITDA, they're all, cash flow. Sometimes like on Biz Buy Sell, you'll see cash flow. All these phrases can be manipulated based on how much work that seller was doing. And sometimes actually there's a reverse incentive, actually a bad incentive for the seller to do more tasks, to pay himself more or herself more, almost as like a W-2 salaried management, position. But I'm raking in all this money as the seller, yet I'm doing everything. I'm doing the books, I'm doing the HR, I'm selling, I'm managing, I'm basically running the whole business. Oh, but I'm paying myself $350,000 a year. Yeah, well, when you as the buyer come in and substitute professional management, maybe it's going to cost you $200,000 to totally replace the seller's role. Okay, well, in that event there, it's not like you as the new buyer is going to be collecting $350. If you have to pay $250 to replace the manager, you're only cutting $100,000. Now, of course, this is a rough example, but you get the gist. You get the gist. You have to work in the true cost of management into your model based on the way that you're going to be running the business. Huge point. Massive point. And for these smaller transactions, $100,000 or $200,000 in free cash flow is a meaningful metric that will legitimately influence how much you're willing to pay for the business. Okay, so that's really a huge one. Now, let's also talk about, just roughly speaking, how much should you be paying in this environment? We're talking in Q4 of 2022, a period right now where interest rates are rising and will probably continue to rise at least for a few more quarters, depending. And equally, we just want to talk about what the nature of small business to small to mid-sized business acquisitions generally is. And generally, you're paying about 3 times earnings. And you're especially not paying more than 3 times earnings right now because interest rates are going up. And as interest rates go up, generally speaking, valuations for assets and businesses and cash flowing assets go down. As interest rates go up, asset values generally go down. Anyone who's been paying attention to the market, whether it's the stock market or M&A transactions, private transactions, you're seeing that valuations, as Jerome Powell keeps turning the dial, as the Fed keeps turning the dial up and increasing interest rates, asset values, stocks, equities, they're going down. So especially in a higher interest rate environment, you don't want to pay more than 3 times earnings. Now, when you're in a 0% interest rate environment like we were a year ago or 2 years ago, back in 2020 and especially in 2021, there sometimes you have to pay 3.5, 3.75 times earnings. But again, you have to be A, mindful of the market and interest rates, but then B, what is earnings? Well, it's the earnings you expect to be able to pocket before your debt cost as the buyer. Okay? In other words, don't give the seller credit for doing the core management aspects of the business. A business should have management in place, in my opinion. And if you want to do multiple deals, you need to have management in place. So don't give the owner, this is a huge one, I just keep emphasizing it because I don't want you to make this mistake. Don't give the seller credit if he or she is wearing all the hats. That's a negative, not a positive. Unless if you want to be an owner-operator and only do one deal one time. Okay, that's important. So now we understand, right, that you need to calculate your own net income metric for the business based on whether or not there's going to be management in place, preferably you're putting in your own management, how much are they going to cost? Honestly, don't go light on this one. I've made that mistake before. I don't want you to make that mistake. So calculate a real sense for what they're going to cost. And then also look at things like rent. You know, are you going to be taking over the existing facility? Are you going to have to buy a new facility? Are you going to be increasing to a larger facility? Are you downsizing to a smaller facility? What's going on with regards to rent? And what's going on, more importantly, with just the overarching aspects of the operation? Maybe, for example, you have a really great relationship with your insurance guy or vendors, and you've already done a few deals, and you can immediately create economies of scale and reduce your operating expenses as a result of doing this transaction because you already have existing businesses that have meaningful relationships with vendors or insurance, et cetera. Then maybe in that event, you realize by you doing this deal, you're going to actually keep more net income than the existing seller because you have relationships he or she doesn't have. Doesn't mean necessarily you want to pay more for it, but it means you potentially could pay a little more to get that deal done if you had to in a negotiation. The other side is maybe you have less relationships than the existing seller, and the existing seller is leveraging his or her own persona a lot in getting certain deals and making certain business happen, etc. That's the opposite then. You want to pay less for that business because when that seller quits, retires, goes for the hills, whatever, those relationships that he or she has, if he doesn't transfer them or if she doesn't transfer them onto you, then you're going to miss out on those relationships. It's going to hurt your bottom line. Maybe there's less sales or your cost of goods goes up, things of that nature. Okay, so it's really important, again, to just keep going down the rabbit hole and analyzing what is this business really going to look like when I own it? Not when the seller owned it, when I own it. So important because, look, you're not going to pay future debt and you're not going to take a paycheck. You're not going to pay yourself based on past performance of the business. You're going to pay yourself and you're going to collect net income and you're going to either succeed or fail based on the future performance of the business when you're the owner. It's so obvious, but people don't think about this when they're analyzing the deal. They think, oh, well, the business used to do this, so I'm going to make those assumptions that that's just going to continue forever. Why? Why would you make those kinds of assumptions? Why would you just blindly assume that whatever the business did in the past, it's just going to keep doing in the future? You ever heard of the business called Blockbuster? Do you still rent your movies from Blockbuster? Okay, for those of you who are too young to know, Blockbuster used to rent movies, physical DVDs, and actually I think mainly VHS, old school movie rentals, right? They're dead. Now everyone goes and gets their movie on Amazon Prime or on Netflix. Okay, so past performance doesn't guarantee future profit. Just remember that. Okay, this is where you have to look at the qualitative variables, like what industry are you going into? Is that industry generally projected to go up or to be going down? I mean, by the way, if you're going into an industry that's projected to go down, I'm not sure I'd do the deal. That's my 2 cents, but your prerogative, you're the entrepreneur here. Okay, but you have to take an analysis of the industry. Also, you have to analyze the local geography. Is this a micro environment that looks to be going up or going down? Are you buying a business in a ghost town or in a booming town that's growing into becoming a larger city? meaningful stuff here to think about. Okay, and there's a whole bunch of other micro trends you could be thinking about. Analyze the other competitors in the local market. Is there a likelihood those local competitors are going to be able to dominate you? Or equally, is there a lack of local competition and you're going to have the ability to really dominate that local market? Based on these qualitative variables, you may be willing to pay a little more, a little less, and you may project more or less bottom line profit in the future based on, let's just say where the puck is going. Right? You have to be able to really calculate in your own mind and also then quantitatively, meaning through numbers, how much income is realistic to expect out of this deal based on where the puck is going, based on market conditions. Are we entering a bull market, a bear market? Is the economy looking to slow down versus grow? Is this a good industry? Is the industry growing? Is the local market going to be giving me a lot of opportunities, or is the local market shrinking? Am I in a state that's favorable as far as doing business? What are the politics like in the local market I'm in? Okay, am I going to have, elected officials that are going to be helping me grow or hurting my growth? Okay, doing business, as of the time of recording this, in California is a very different proposition than doing business in a state like Florida or Texas. If it were me, I'd pay a little bit more to be in Florida or Texas than it would to go to California. Heck, I don't even look at deals in places like California because I just think, candidly, there's too much government intervention, there's too much tax, there's too much risk and liability for me. That's my investment thesis. Okay, you're welcome to borrow that, and I would implore you to really think about these variables. Okay, because not all two deals are created equal. Okay, I'm in the plumbing and HVAC business. We make acquisitions in plumbing and HVAC. By the way, breadutilities.com if you're an accredited investor and you want me to do the hard work for you. But I digress. We don't make investments in places like California. We're not investing in these very blue markets where the government can snap their finger and shut your business down, as we saw back in 2020. And then keep it shut down. Everyone shut down for a minute when we were trying to figure out what was going on, but then some places kept it shut down. Not Florida, not where I am. Not Nebraska, not where I own property. Okay, those places let it ride, and that's what I'm looking for as a buyer. So I'm willing to pay a little bit more in those kinds of markets, and I will expect that I may have a little bit more cash flow, aka net income, that I'm going to keep and take as the new buyer, as the new owner, if I'm in a positive market. If I'm in a positive market, I can expect more cash flow. Okay? So these are the kinds of things I really recommend you think about. At the end of the day, you also have to ask yourself, how skilled am I as an operator or as a manager of manager in this specific sector that I'm getting into? If I feel really good about myself as a manager or as a manager of managers, and I know I can make this business grow, then in my analysis, I can have more favorable projections. I don't want to get too high in the sky. Okay, I want to stay sober when doing my analysis. This is my 2 cents. I recommend you take this one. Okay, don't get too high in the sky. Have a worst case scenario in your analysis, but take into account your own skill, your own track record. Is this your first rodeo? If it is, it's going to be a lot harder for you than if you've done this a few times. Okay? So those are things to think about when you're calculating how much you're going to take home as the new buyer, when you're assessing value for a business, and when you're looking at the bottom line that's going to basically help you pay off your debts and pocket net income and basically make this business a good investment. Okay, before we finish up, I want to talk about what financial documents should you take most seriously. And the answer, if you've been watching my channel, is clear. The tax return is the most important financial document of all. It's more important than the P&L, though the balance sheet is very important. The tax return is the most important financial document of all. And oh, by the way, once you learn how to read a tax return, you can actually find both a version of the P&L and a version of the balance sheet in the tax return. Why is the tax return so important? Because it's the financial document that the seller, the current existing owner that you're looking to buy the business from, has to send to the government. It is the document you have to send to the government, and it is a federal crime to falsify your tax return. That's the key. It's a federal crime. It's a felony to falsify your tax returns. So when your tax returns are submitted to the government, you're blessing them and saying, I did them correctly. I'm not falsifying any financial documents here. This is the true nature of my business. Okay? No funny stuff. And so isn't that the most important thing you're trying to get a true assessment of as the buyer? You're not trying to buy a business based on how much this guy can puff up and fatten up is QuickBooks. You want to buy business based on what the business actually is doing. Thus, the tax returns. I have a different video on my channel where I show you how to read tax returns. I would implore you to watch that video. But this is the key. Okay, of course you want to look at the balance sheet. You want to be analyzing things like, what is the cash flow cycle of this business? Because this is another really important one. If the business takes a long time to get paid, then you're going to have to keep more operating cash in the checking account for the business, which means you can't distribute and take out as much cash out of the business. If the business needs to hold on to a lot more cash relative to net income because it has a slower cash flow cycle, then candidly, the business is worth a little less because you have to leave a larger sum of cash in the business that you can't utilize for yourself and for your shareholders in that event. Equally, if the business is paid fast, immediately collects cash, and doesn't require this long cash flow cycle, then that's a great thing. That means you can most likely leave less operating capital in the business. It means your cash flow cycle is tighter. It means you can distribute profits more quickly and easily with less risk. That's a benefit. I'll pay a little bit more for that business. Okay, but these are the kinds of things you have to analyze. Look, we could talk about this all day long, but at the end of the day, this is the foundational video for how to analyze what the true net income or bottom line profits of a business are going to be in your ownership. Not the existing ownership. I keep making that point because I've seen a lot of clients who come in with this falsified perspective on how to analyze value. Oh, well, it used to do this much and da-da-da-da. So what? Great, the business used to do this much. What you're buying is what it's going to do for you. Be more selfish. Be more selfish as the buyer. Why would you buy something if it's not going to benefit you? You don't go to the store and buy something that's not going to benefit you. Why would you spend your money? Why would you spend your money? You wouldn't. It'd be crazy. It'd be suicide. Why am I going to spend my money based on something that doesn't benefit me? Ask yourself that question through the entirety of diligence, and you'll do all right. Okay? If you like this one, thumbs it up. Go to jasonpaulrogers.com if you want to learn more about how to buy businesses, if you want my help in showing you, as somebody who's done it, how to buy businesses. If you're an accredited investor, go to brighterutilities.com. There's investment opportunities that we are always lining up that you may be able to participate in. You have to be accredited, okay? But otherwise, thank you for watching. Share your comments below, and I'll talk to you in the next video. P.S. Subscribe, okay? Let's do this again.